Hello everyone, I Professor Chirag Goyal, Direct Tax faculty from JK Shah classes, welcome all of you here. Friends, we are meeting today for a very important discussion which is regarding the statutory updates applicable for November 22 paper of Direct Tax. Now friends, as you people must have seen that Institute has uploaded a statutory update PDF on the ICAI BOS knowledge portal. There's a 12-pager PDF which they have uploaded recently covering all the statutory updates which are applicable to the November 22 paper. I'll just open that PDF for you. This 12-pager PDF has got uploaded on your BOS knowledge portal by the Institute recently, which covers all the statutory updates and amendments which they have made applicable for the November 22 examination of Direct Tax. Friends, the June 2021 edition of your study material, that is containing all the provisions which are amended as per Finance Act 21. As it was already informed to you guys in your lectures that Finance Act 2021 is applicable for November 22 examination. However, from May 23 examination, Finance Act 22 will become applicable. So friends, as you people know that Finance Act 21 is applicable for year attempt, all the updates which came in Finance Act 21, they were already incorporated even in your study material which you must have received from ICAI, even in your JKSA textbook, all the updates of Finance Act 21 were incorporated. However, friends, government keeps issuing notifications and circulars periodically over the period of time, and any such significant notifications or circulars which get issued up to 30th April 22, even they become applicable for November 22 examination. There are chances that these updates may not have been covered in your study material as well as even during our discussions of all the lectures. So now this video which you are seeing right now, which we are uploading for you, is going to cover only those specific topics or those specific updates which we might not have covered during your lectures, and which are very important from the point of view of November 22 examination. Friends, if you look at this 12-pager PDF, any students who have already appeared for May 22 examination who unfortunately could not clear May 22 examination, if they are again reappearing for November 22, this statutory update, let me tell you, is even applicable for them. So this statutory update is not just applicable for students who are giving November 22 attempt for the first time, even for the students who gave May 22 or any attempt prior to that, but who could not clear it and now they are reappearing. So this statutory update PDF is applicable even for those students. But any student who already appeared for May 22, friends, a similar such PDF was already discussed by us even before your May 22 examination. There was a similar kind of video which was recorded at that point of time, and that was already made available to all the May 22 students. That same video is even available on JKSC of this YouTube channel. So any student from November 22 examination, you can watch that same video on JKSC YouTube channel. You will get that same video. See, why I am telling you to refer that old video again is the reason because if you look at this PDF, and if anyone has the PDF of May 22, friends, majority of the clarifications which were covered in May 22 statutory update PDF have been again reiterated by ICAI in this statutory update PDF for November 22. So the discussion which I am going to have now in this video will not include all the amendments which I have already discussed in my previous video, for May 22 exam. So friends, for all those previous discussions, like I can tell you the markings capital gain, this first amendment which is appearing in capital gain, apart from this note will be discussed by me in this video, but apart from this note, that initial part of slum sale has already got covered in the initial video of May 22. So that you have to refer from May 22 video. Similarly, this advanced tax TDS, friends, this specified bank discussion as well as guidelines for 194Q, even they have been already discussed by me in the May 22 video. So even this has to be referred from May 22 video. Today, I am going to cover in this video only those updates and amendments which are not already covered in May 22, which have come afterwards and which are specifically applicable for November 22. So friends, there are basically 5 major updates. One is in deductions chapter, which is talking about taxation of ULIPs. Second major update is in TDS TCS chapter in that foreign remittance concept. Third major amendment is in assessment procedure, or you can say return of income chapter, in the mandatory applicability of filing return of income. As well as last major update, one more major update is in PAN to Aadhaar linking, and then fifth one you can say consequences of not linking PAN to Aadhaar. So friends, all these updates which are specifically applicable just for November 22, which were not covered already in May 22 video. So once again I am saying friends, May 22 video covers half of the statutory update PDF of November 22. So those things you have to refer from May 22 video. Even the November 22 students, you have to refer it from May 22 video. But the things which are additional in this PDF, for that we have prepared an additional summary of this 3-pager PDF, which will be shared with you guys. Okay, so you can refer this PDF along with the May 22 statutory update and that video of May 22. Now, friends, understand once again in this PDF, we have mentioned that this PDF is applicable for all the November students, either fresh students who are giving the attempt for the first time or who are giving second or subsequent attempt. It is applicable for everyone. Now, all the updates which are issued by ICAI in November 22, they include some of the updates from May 22 attempt. So once again, we have mentioned in this PDF that we are not going to cover those repeated updates in this video. Those concepts you are advised to watch from our May 22 inter statutory update. You can type this on YouTube. You will get that video available. It is available on the JKSC official YouTube channel. Only the new updates are covered in this PDF or video. Okay, pay attention friends. The first important statutory update, as I said, has come in deductions chapter. Friends, in deductions chapter, we had seen a section which was section 80C, which was covering life insurance premiums. I'll first give you just a small brief of this life insurance premium section which we had discussed in 80C. Friends, in 80C there were list of investments which were allowed as a deduction while calculating your gross total income under section 80C. If you are making investment in any of these investment schemes, like if you are purchasing bonds of NABARD, ULIP, life insurance policy, tax saver FD, etc. All these various investment schemes were given under 80C, one of which was life insurance premium, life insurance policy. So friends, in 80C, we had seen how life insurance premium is allowed as a deduction. Life insurance premium for a policy taken prior to 2012, maximum premium which was allowed as a deduction was 20% of sum assured, and for a policy taken after 2012, it was restricted to 10%. Then again in 2013, that 15% criteria was introduced only for people who were suffering from diseases, specified diseases under section 80 DDB, or any disability specified under section 80U. Basically friends, these percentages criteria were specified in ATC. If your premium was exceeding these percentages, then deduction under ATC used to get restricted up to the extent of these percentages. Jointly, along with this section, we had seen a section 10 clause 10D in non-taxable income chapter, wherein we had seen that maturity proceeds of life insurance, this is fully exempt if the policy is meeting all these percentage criterias. Like if you remember, I must have told you that friends, if the policy is taken prior to 2012, since the maximum premium which was allowed as a deduction was 20% of sum assured, let's say if I had taken a policy in the year 2010, my sum assured, policy sum assured was 2 lakh rupees and the annual premium which I used to pay for this policy was only 10,000. Friends, can I say if my annual premium was only 10,000, then 20% of sum assured is 40,000 rupees. So since it is less than 20%, therefore section 10 clause 10D used to say whenever maturity proceeds are received from this policy, such maturity proceeds are fully exempt. Maturity proceeds from such a policy, they were fully exempt under section 10 clause 10D. However, a very important update while taking your lectures would have been discussed by me with regards to ULIP. That any ULIP which is taken on or after 1st Feb 2021, which is having an annual premium of greater than 2,50,000, either for a single policy or aggregate premium for multiple policy, then such ULIP is no longer considered as a ULIP, unit linked insurance plan. It is considered now as a capital asset. This important amendment would have been discussed by me towards the end of your direct tax syllabus when I discuss the other provisions of non-taxable income chapter. So friends, there's a very important guideline issued or clarification issued by government with regards to this ULIP amendment, and it's actually a good news for you guys. This entire ULIP amendment is now removed from Inter CA syllabus. They have made this ULIP amendment now applicable only for final CA. So friends, in short, I can tell you that ignore that ULIP part which I had discussed in that along with section 10 clause 10D. Simultaneous correlation I would have given to you in capital gain chapter, that now definition of equity oriented mutual funds has got amended. It includes ULIP now, so even that part has to be ignored. Even the tax rates would have been discussed by me in under section 112A. Even that part has to be ignored. Section 45, friends, this section 45 subsection 1B which you are seeing is the capital gain taxability provision which used to tax this ULIP. But finally, even this section 10 clause 10D, 112A and 45 1B only with respect to ULIP concept is not applicable in CA Inter. I am once again saying, friends, do not misunderstand as section 10 clause 10D has got removed from your syllabus. Section 10 clause 10D is still applicable. Section 112A is still applicable. All the remaining provisions of section 45 are also still applicable. So section 10 clause 10D, now you have to remember only the ordinary life insurance policies, unless it is a ULIP. If it's a ULIP, completely ignore that. But if it's an ordinary life insurance policy, then for an ordinary life insurance policy, these percentage criteria are still applicable. So if I have taken a ordinary life insurance policy like this, the example which I gave, if I have purchased an ordinary life insurance policy like this part you have to still remember, it is still there in your syllabus. Only the ULIP related amendment has been removed from Inter CA syllabus. Now let's discuss the second important update which is applicable for November 22 exam. Friends, this second important update has come in TDS TCS chapter. In TCS, we had discussed a provision of foreign remittance. I'll just quickly brief you about that provision which we had discussed. Whenever there is a foreign remittance which is to be done by any individual under the liberalized remittance scheme of RBI under Foreign Exchange Management Act 1999, then TCS has become applicable. This TCS had become applicable from 2020 onwards. Friends, in that foreign remittance TCS, what was the applicability? If you remember, any purchase of foreign tour package there was a TCS which was to be deducted by the seller, or TCS to be collected by the seller of the tour package at 5% irrespective of any threshold. So like if you purchase a foreign tour package for a trip to Switzerland, in that case, if you go to a tour operator and tell him that, boss, I want to book a trip for Switzerland, you please do all my bookings for a trip of 5 days, 4 nights to Switzerland. What he will do is, whatever is the total value of that booking, he will collect extra 5% TCS from you irrespective of any threshold. There was no threshold as such in foreign remittance TCS on purchase of foreign tour package. Similarly, friends, there was applicability of TCS even on remittance which was done for payment of any education fees by taking an education loan. However, since this was a genuine person appearing to government, they kept the TCS rate as only 0.5% and that too above on value above 7 lakh only. So if you are remitting some money by taking education loan, let's say 6 lakh rupees, TCS will not be applicable because it is below 7 lakh. But even if you remit 8 lakh rupees by taking education loan, even then TCS will come at 0.5% only on 1 lakh rupees. Similarly, there was a any other purpose loan, any other purpose remittance on which again TCS was applicable at 5% above 7 lakhs. So friends, this was the provision of foreign remittance which we had discussed in TCS chapter. Now there's a small clarification issued by government in the statutory update PDF which is applicable in this concept. Friends, the concept of foreign remittance is covered under section 206C subsection 1G of Income Tax Act. But as I always advise, no need to remember the section numbers of TCS. You can just remember the section numbers of TDS. However, friends, what's the clarification? See, understand the clarification given is, if a person who is remitting money outside India is a non-resident in India and who is on visit of India, then TCS will not be collected. Understand, friends, example, let's say if Mr. Jaffrey, he is coming to India from Canada. He is a non-resident of India during the year because he is actually staying predominantly in Canada. So during the year, he happens to be a non-resident. Now friends, this Mr. Jaffrey, when he came to India, he brought some money along with him. It's possible that he is bringing some money along with him, like 2-3 lakh rupees in INR terms. Now when he came to India, the purpose of coming to India was visit to India. His purpose of coming to India was visit to India. So friends, when he was there in India on his visit, he received a phone call from his family members who are staying still in Canada saying that we are right now in some urgent need of money. Possible? It is possible. He received a phone call from his family saying, we are in some urgent need of money, please send us some money. Now this non-resident who has nothing in India, no bank account, nothing, he has just come to India for visit purpose. He has to send some money immediately to his family members outside India. Don't you think even he will go to a forex dealer authorized by RBI, who is authorized to buy the Indian rupees and give foreign exchange? So he will go to that forex dealer, he will give that Indian rupees which he was holding when he was there in India, and he got them converted into foreign exchange and remitted this money outside India. Point is, even if that money is, let's say, more than 7 lakh, will TCS be applicable? Let's say he brought more than 7 lakh in India in INR terms, not just 2-3 lakhs, more than 7 lakh, and he wants to remit more than 7 lakh outside India in INR terms. Will TCS be applicable in this case? This was what the confusion was amongst the people who were non-residents and were coming to India for visit purpose. So government finally clarified that no, your TCS will not be collected, because think rationally, friends. What will government of India do by knowing that how much is that non-resident sending to his family members outside India? Because anyways, I hope you understand and remember, friends, TCS provisions were just for reporting purpose. Government wanted to get reporting of how much money people were sending outside India and whether they are offering that much adequate income in their returns or not. This person is anyways a non-resident. He has anyways come on visit to India. He will anyways leave India after his visit is over. So what will government do by getting this information? So that's the reason government clarified that TCS will not be collected in this case. For a non-resident who is coming to India and who is on visit, both are and condition, friends. Focus on the word and. Both are and conditions. If the non-resident is coming to India and is coming on visit to India, then only TCS is not applicable. Next update is in assessment procedure. Understand, you can also call it as return of income, because we must have studied this chapter as return of income. Friends, what is the update in this chapter? If you remember, we had discussed a section 139 subsection 1, which says when it is mandatory for a person to file return of income. I'll just quickly brief you about the provisions of when it is mandatory to file return of income. Friends, if you recollect, for a company or a partnership firm or a limited liability partnership, it is always mandatory to file return. They cannot give an argument that our income is less. No, your corporate structures, you have to, even partnership firms taxable as per flat rates, you have to file a return of income. However, if the assessee is individual, HUF, AOP, BOI or AJP, return filing is mandatory to them only when their total income is greater than basic exemption limit. Now, when I say total income is greater than basic exemption limit, I am referring to those same basic exemption limits which were studied in the first chapter for a individual who is not a senior citizen or super senior citizen. Limit was 2,50,000. For a person, for an individual who is resident senior citizen, it was 3 lakh rupees. For an individual who is resident super senior citizen, or you can even say very senior citizen, it was 5 lakh rupees. Now friends, if the total income is greater than basic exemption limit, only then return filing was mandatory. What do you mean by total income here? This total income was before claiming chapter 6A deductions as well as before taking those capital gain exemptions. That complete series of 54 EC, etc. So similarly friends, company, firm, LLP, it was always mandatory. Individual, HUF, AOP, BO, IJP, if only total income was greater than basic exemption limit. Total income means before claiming chapter 6A deductions and before taking capital gain exemption. Friends, this was the original criteria of when return filing is mandatory. Then over the period of time, government kept adding some other criterias, like they added a criteria specifically for ROR, saying that if you are a resident and ordinarily resident, and if you are beneficial owner of any asset outside India, or if you are having a signing authority in any account outside India, or if you are beneficiary of any asset which is situated outside India. So either beneficial owner or having signing authority or being a beneficiary, even then, irrespective of how much is your total income, still return filing was mandatory. Similarly friends, government also added some more criterias later on, saying that if you are any person, now these criterias were not added only for ROR, they were added for everyone, that if you are any person who has deposited greater than 1 crore in any current account which is held with any bank, whether it is one bank, two bank, multiple banks, doesn't matter. If you are depositing greater than 1 crore in any current account during the year, then also return filing is mandatory for you. Or if you are spending greater than 2 lakh rupees on foreign travel of either yourself or any other person, again return filing was mandatory. Or if you are paying electricity bill of greater than 1 lakh rupees, again return filing was mandatory. So friends, till last financial year, we used to see only these many criterias, that company, firm, LLP always mandatory, individual, HUF, AOP, BO, IJP only if the total income is greater than basic exemption limit. For a ROR who is beneficial owner or of an asset outside India, or having signing authority in an account outside India, or beneficiary of an asset outside India, in all these cases return filing was mandatory. Then if he has deposited greater than 1 crore in any current account, or his spending is greater than 2 lakhs on foreign travel, or he is paying electricity bill greater than 1 lakh, in all these cases return filing was mandatory. Now friends, one more rule 12AB has got added in this section 139 subsection 1, which has again introduced further 5 criterias of when return filing will become mandatory for the person. So now friends, there are very high chances of a question being asked from this amendment. This update is one of the most important update of all the 4-5 updates which Institute has issued. So understand friends, this rule 12AB, what are the cases covered under rule 12AB? First is any person carrying on business. Business means same which we had studied in PGBP chapter. A person carrying on any business and the turnover in the previous year. So if you are checking whether he is required to file return of income of 21-22 or not, you have to check the turnover of 21-22. If the turnover is, you don't have to check the turnover of any preceding previous years, only 21-22. If it is greater than 60 lakhs, then also return filing becomes mandatory. Or a person, friends, focus everywhere they are writing the words person. So wherever they are writing the words person, it includes all the 7 category of persons which you had seen in the definition of person. Okay, so it can be even a partnership firm, even a Hindu undivided family, even a company, any person carrying on business and the turnover in the previous year is greater than 60 lakh rupees. Also focus on the sign, because they are saying greater than 60 lakh. Even if it is exactly equal to 60 lakh, this provision is not applicable. A person is carrying on profession and the gross receipt in previous year is greater than 10 lakh. So friends, again, profession can be anyone, either specified professionals, those chartered accountancy, lawyer, doctor, etc. Or it can be anyone from other professions, like it can be a painter or a cricketer, etc. So a person carrying on profession and his gross receipts in the previous year is greater than 10 lakh rupees. Gross receipt and turnover, both these words refer to the gross billing of the assessee. Gross receipts and turnover both refer to the gross billing. In case of businesses, turnover will also include other business receipts. Okay, so understand, a person carrying on profession and the gross receipt is greater than 10 lakh, even that person has to mandatorily file the return. So if I am a painter and if I am doing any profession, I come under any other profession. So if during the year 21-22 my gross receipts are 12 lakh rupees, even if I am not liable to file return because of any of the above criterias, like I claim that my total income is below basic exemption limit and all that stuff. So if I claim any of that criteria is not becoming applicable for me to file the return, government says now this criteria will tell you, you have to file your return of income. And all these are all criteria. So even if first one is satisfied, second one, or look at the third one, because this third one is very important. A resident individual who is aged greater than equal to 60 years. So can I say they are talking about resident senior citizen? A resident individual who is greater than equal to 60 years, if that person is having total TDS and TCS which has got deducted or collected greater than equal to rupees 50,000 during that previous year. Like friends, if in 21-22 they tell you that Mr. A, he is a resident and his age is, let's say, 62 years. See, whenever they use the words resident senior citizen and they make any provision for that, it by default includes super senior as well. Do not say that since they have said greater than senior citizen only, it will not include super senior. That's why in our notes we have written greater than equal to 60, so that you understand even super senior will get covered. So Mr. A, resident age is 62 years. If he is saying that because of any the other criterias, any of the above criterias, he is not liable to file return, but his TDS TCS which has got deducted or collected during the year 21-22 is, let's say, greater than equal to 50,000. Friends, focus on the signs. In the first two conditions, they are not, in the first two situations, they are not using equal to. But in the third one, they are using equal to. So even if it is, this is where institute can trap you, even if it is dot equal to 50,000, still this condition will get satisfied and return filing will become mandatory. Friends, why this provision got introduced, this one? Because many people, they are under wrong impression that once their TDS TCS gets deducted, collected, now why they are required to file return. So there are many people who don't file their returns just because their TDS TCS is getting deducted, collected. Government says, no boss, if your TDS TCS is greater than equal to 50,000, then also we want you to file your return of income and disclose your other incomes, because not necessarily on all your incomes TDS TCS would have got deducted or collected. So you also have to compute your total income. You also have to file your return of income, disclosing any income on which TDS may not have got deducted. So this is one of the most important criteria which is applicable now for filing return. Any resident individual greater than equal to 60 years, total TDS TCS is greater than equal to 50,000 during the previous year. Friends, this limit of 50,000 is only for resident senior citizen. If the person is any other person will again now include anyone other than resident senior citizen, as well as all the category of other persons like HUF, AOP, BOI, AJP, etc. So even a non-resident aged 60 plus, he will come under any other person. So for them, TDS TCS limit is even less. If it is rupees 25,000, greater than equal to 25,000, then also return filing will become mandatory. So friends, I will give you quickly few examples. Answer in all these cases. Let's say in the first case, Mr. A, he is a resident. Let's say his turnover is 40 lakhs. He is doing a business, his turnover is 40 lakhs. Now, he is saying that my TDS, TCS which has got deducted or collected is only 30,000 during the year. Can I say, if they tell you his age as 64 years, then you will check the criteria of 50,000 for TDS, TCS, resident, senior citizen. Turnover criteria is not getting matched anyways. TDS, TCS is less than 50,000 in this case. So return mandatory or not mandatory? It is not mandatory. But if I change the age to, let's say 52 years. Friends, if I change the age to 52 years, then don't you think you will check 25,000 limit? So since it is 30,000, then return filing will become mandatory. Similarly, if I tell you, what if he is a non-resident? If he is a non-resident, then anyways, irrespective of age, if he is a non-resident, then also 25,000 limit, this return filing will be applicable. So remember friends, whenever any resident individual who is greater than equal to 60 years and total TDS TCS is greater than equal to 50,000 in the previous year, only then return filing is mandatory. For any other person, limit of TDS TCS is 25,000 only. Friends, even if you are not satisfying any of these four criteria, there's one fifth final criteria saying any person depositing greater than equal to, once again the sign used is equal to, greater than equal to 50 lakhs in all the saving bank accounts. So again, focus on the words all the saving bank account. If you are having 10 different saving accounts in 10 different banks, doesn't matter, in all the, whether 10 different banks or even one same bank 10 different saving accounts, doesn't matter. Any person deposited greater than equal to 50 lakhs in all the saving bank accounts in the previous year, again return filing becomes mandatory. So any of these five criteria can be asked in the question, friends. They can give you any person. Just remember these criteria over and above whatever we had discussed in section 139 subsection 1, that a person carrying on business and turnover is greater than 60 lakhs. A person carrying on profession and gross receipts in previous year is greater than 10 lakhs. A resident individual greater than equal to 60 years and total TDS TCS deducted or collected in the previous year is greater than equal to 50,000. Any other person, total TDS TCS deducted collected is greater than equal to 25,000, or any person deposited greater than equal to 50 lakhs in all the saving bank account in previous year, they are mandatorily required to file return of income. Last update has also come in this chapter only, friends. That is under section 139 AA. I'll just quickly brief you about this section. Friends, section 139 AA was talking about mandatory quoting of Aadhaar. Friends, wherever you see, you open any income tax website, in news also, you will see all these advertisements of PAN linking with Aadhaar. Government was consistently saying that please link your PAN card with Aadhaar, please link your PAN card with Aadhaar. The last date to link PAN card with Aadhaar was 31st March 2022. And now, as you see, friends, even that date is gone. 31st March 22 is also gone now. So now what to do? If someone could not link the PAN with Aadhaar up to 31st March 22, government was saying that your PAN will become invalid after that date. So is it, friends? Has the PAN actually become invalid of that person? Government says no, don't worry. a new section has got inserted, friends, 234H, which is again allowing a further window of 1 year. Government says, boss, again we are allowing you time of 1 year to link your PAN card with Aadhaar, but now it will not be free linking. What does this mean, friends? Up to 31st March, when you were linking your PAN card with Aadhaar, government was not charging any fee? No, it was of completely free linking. But now if you want to link your PAN card with Aadhaar, government is charging late fee. And this late fee is written under section 234H. Friends, this 234, it might sound familiar to you. Section 234A, interest on default in furnishing return of income, studied in return of income chapter. 234B and 234C, default in advance tax provisions, studied in advance tax chapter, 234B and 234C. Interest late fee under section 234F for delayed filing of return of income, even that was studied in return of income. Now 234H has got added in that same order, friends. Late fees for linking of PAN card with a PAN number with Aadhaar. Friends, if the PAN is linked with Aadhaar after 1st April 22, government says that up to 3 months, that up to 30 June 22, late fee will be only 500 per linking. So if you want to link Aadhaar with PAN of all your family members, there are 5 family members and none of the Aadhaar was linked with PAN before 31st March. So now for all the 5 family members, you will have to pay 2,500 total. 500 per family member. So behind every linking now, they are charging 500 late fee up to 30 June. Friends, even that date is gone now. So after 30 June, see what is the late fee. Government says that after 30 June, you do whenever you want. Late fee will be 1,000 rupees. Okay, so there is a late fee for linking PAN with Aadhaar now, but yes, it can be still done. Your PAN, even if it has become inactive, you can activate it again by paying this late fee of rupees 500 up to 30 June if you link it up to 30 June, but after 30 June, it has become 1,000 rupees. Sir, what are the consequences if ultimately PAN and Aadhaar are not linked? Friends, as I said, government has allowed you a window of 1 year. So even if you could not link it up to 31st March 22, government is allowing you 1 more year up to 31st March 23. But if you don't link up to 31st March 23, then from 1st April 23, they will apply these consequences. They have introduced a very new rule, which is rule 114 AAA. Don't get scared looking at the name. No need to remember that rule number, rule 114 AAA. Government says that these are the consequences. A theoretical question to the extent of 4 marks is expected on this concept. That what are the consequences of not linking PAN with Aadhaar after 1st April 23. You have to state that, first of all, that person cannot file any income tax return then. No return can be filed. Secondly, if that person had already filed any return in past in which he was claiming some refund from government, like let's say in 2021 he had filed his return in which he was saying that he has a refund of 30,000 due from government. Government will not process his refund now. Government will not give him his refund. Similarly, no processing of return already filed. So friends, if he had already filed a return of 21-22 as well, which was pending for processing, government had not processed that return. Government will not do the processing of that return. That return will be treated as invalid. Similarly, no processing for rectifying defective return. If you recollect, we had discussed a concept of defective return, section 139 subsection 9. Friends, defective return, whenever government department discovers any mistake in the return of income of the assessee, they send him a notice to correct that defect within 15 days. So friends, if your return became defective on, let's say, 25th March, then 25th March 23, your 15 days are coming after 1st April as well. The moment you don't link your PAN with Aadhaar up to 31st March 23, gone. After 1st April, you cannot even rectify that defect in your return if you could not do it before 31st March. And the fifth consequence is the biggest consequence, friends. Higher TDS TCS will be deducted collected if no PAN given. Friends, when you read these words, no PAN given, you will recollect a provision which we had discussed in this chapter, TDS TCS, section 206AA, that whenever payer has to deduct TDS of payee, or even in TCS similar provision was that whenever collector has to collect TCS of the collectee, they will ask PAN from that deductee or payee or collectee. If the payee or the collectee is not giving PAN, then there were consequences. TDS, friends, consequence was TDS will get deducted at actual rate or 20%, whichever is higher. So if the TDS was to be deducted under section 194J, actual rate is 10%. If he is not giving PAN, then 10% or 20%, whichever is higher, is becoming applicable. Now understand, friends, if you don't link your PAN card with Aadhaar up to 31st March 23, your PAN will become invalid, and in that case, even if you give that invalid PAN to that payer, it will be treated that payee has not given any PAN to the payer. Even after giving PAN, it will be treated as he has not given any PAN to the payer. And in that case, because your PAN has become invalid, so in that case, that higher TDS TCS consequence will become applicable. So remember, friends, these are the only most important updates which have come in statutory update PDF. You will see that in that 12-pager PDF, lot of the things are same which we have already covered in May 22 video. So you are requested to please go through that May 22 video for going through all the remaining updates which are there in that 12-pager PDF. Rest all the others which are not covered in May 22, which have come right now in November 22 only, I have discussed in this video. Most important one is this ULIP, friends. Remember that ULIP has now got removed from Inter CS syllabus. No need to waste your time in studying the provisions of that ULIP. Second major amendment is, friends, this Rule 12AB. Read this very carefully. Now there are additional conditions prescribed when a person has to mandatorily file his return. So that's it, friends. These are the only statutory updates. So thank you very much, friends. Best of very good luck. All the very best. If you still have any doubts, JKSC helplines are always there for your assistance. Thank you very much, friends.